Hello again, everybody. This is Bob Icino from Path Trading Partners, along with my co-founder, Mike Arnold. And this is another in our technical tool series, Technical Indicators as Applied to Cryptocurrencies and Traditional Markets. This is an indicator called the Awesome Oscillator. That's right, it's actually in a lot of your charting packages, and it is actually called the Awesome Oscillator. Not one I use personally, but it's always good to know what all of these different things are as you start your trading career. So the Awesome Oscillator. The Awesome Oscillator is an oscillator that was developed and obviously named by Bill Williams. Traditionally, it has been used to measure market momentum. It uses simple moving averages in its calculation. So please see our technical tools series covering the simple moving average for more information on how it is calculated and utilized by traders. It's always good to know how the component works before you work on an oscillator or an indicator that includes that component. So let's talk about the Awesome Oscillator calculation. So the Awesome Oscillator traditionally uses the 34-period simple moving average and the 5-period simple moving average in its calculation. The simple moving average calculation does not use the closing price, but instead uses the midpoint price, which is simply a bar's high plus its low divided by 2. So the Awesome Oscillator's calculation, the simple version of its calculation, is simply the smooth moving average of the 5-period, so the high, but the midpoint of it, or the average of it. So the high plus the low divided by 2, minus the 34-period simple moving averages, high plus low divided by 2. So again, it uses the midpoint, doesn't use the open or the close or the high or the low. It uses the midpoint of the average. So the Awesome Oscillator is usually plotted as a histogram at the bottom of the chart. So it'd be one of those sort of sidebars, or rather I should call it a bottom bar, filled in with a histogram. If the midpoint price is greater than the 5-period simple moving average, then the histogram will be green. If the midpoint price is less than the 5-period simple moving average, then the histogram will be red. If the 5-period SMA is above the 34-period SMA, then the histogram is plotted above the zero line. And if the 5-period SMA is below the 34-period SMA, then the histogram is plotted below the zero line. It is interesting to note that the default SMA levels of 5 and 34 are both part of the Fibonacci sequence. So obviously, Bill Williams was a fan of or aware of the Fibonacci sequence, if not good names for oscillators. He definitely wasn't a fan of good names for oscillators. Let me turn it over to Mike to go over the way these work and look on the charts. Mike, it's all yours.
Thank you very much, Bob. So here's an example of that awesome oscillator. You can see the histogram on the bottom being red or green. So when the 5 is above the 34, it's green. When it's below, it's red. So this is very useful to see where and when it crosses the axis. We can't really show you when the midpoint price is above when it goes from red to green, but you can easily see when it crosses the axis is when the moving averages cross back and forth. So here you have the moving average crossing the 5-period crossing above the 34, and it crosses the axis to the upside. You can see it crossing back below the 34. It crosses the axis to the downside. So that's an easy way to see. Now, you know, the red and the green aren't just determined by when they cross, because it was green well before it crossed the axis. The crossing just tells when the histogram is going to cross the axis, as Bob described. So what do we do with this awesome oscillator? Well, there are 3 major ways to trade the awesome oscillator: the zero line cross, the Twin Peaks setup, and the saucer setup. All of the 3 setups are used for both bullish and bearish trades. Advanced traders who understand the concept of trading divergences can also use divergent setups to initiate trades. So what's the zero line cross? Well, this is the most basic setup a trader can utilize. The trader is looking to go long when the awesome oscillator crosses above the zero line. This indicates momentum has shifted in the bullish direction. Conversely, the trader is looking to initiate a short trade when the awesome oscillator crosses below the zero line. This indicates momentum has shifted in the bearish direction. All right. So zero line cross, again, you can see how the moving averages are crossing and it crosses below. So we're going to go short there. Oh, and then look, it crosses again here. We're going to go long and then it goes short. Well, this is pretty good if we're in trending markets, but if you're in very choppy markets, this is not a very good strategy because you'll end up going long, short, long, short, long, short, and you won't make much money. So be careful. We're just pointing this out for completeness that this is one of the ways that it could theoretically be used. Don't just put this indicator on your chart and start trading it this way. Twin Peaks trade. The Twin Peaks trade compares two peaks on the same side of the zero line to determine if there's a valid trade setup. It is considered to be a reversal trade. For a bullish trade, both peaks are below the zero line and the second peak has to be higher than the first peak. The trade is initiated when a green bar forms after the second peak. For a bearish trade, both peaks are above the zero line and the second peak has to be lower than the first peak. The trade is initiated when the red bar forms after the second peak. Please wait for the bar to close before initiating the trade because it can switch. You don't know the final color until after the bar has closed. So Twin Peaks trade. So bullish Twin Peaks, we have the oscillator all the way down here. Then we have a higher low and they're both below the zero line. And you see red switches to green. That's the buy symbol. You go long when that bar closes, or the exact open, which would be the open of the next bar. Here's a bearish Twin Peaks. So you have a lower peak above the zero line and you're looking for the green to turn red. You go short. It's actually this next this bar right here. So you'd short on this bar's open. And you don't always have to take this as reversal trades. You can use other entries of exits. So you could use these for entries and something else for exits, like trailing a moving average or some other trailing method to determine your exits, or just use targets for your exits. And this could be an entry-only system. It does not always have to be a complete reversal system. Finally, the saucer trade. The saucer trade is a momentum continuation trade. It is a minimum 3-bar setup. For a bullish trade, the awesome oscillator has to be above the zero line. A minimum of 2 red bars have to appear, with the second being lower than the first, then followed by a green bar that closes higher than the red bar. For a bearish trade, the awesome oscillator has to be below the zero line. A minimum of 2 green bars have to appear, with the second being higher than the first, followed by a red bar that closes lower than the green bar. Please wait for the bar to close before initiating the trade. So here's some bullish saucer trades. You're going to want to use this only in some kind of trending market. This is not good for non-trending markets. So first setup, 2 red bars, green bar higher than the red bar. That initiates the buy. You see next one, 2 red bars followed by a turn up. Green bar initiates another buy. And you can see the repeated buys in this chart as it continues to trend higher. So this can help determine on when to enter after reversal trades. Here's the bearish saucer trades. Again, we're in a declining market. We're not in a choppy sideways market. Now you have 2 green bars, with the second being lower than the first, then a red bar being higher than the green bar. Go short. And again, it doesn't always pinpoint the turning point, but you're going to have some kind of trailing stop with this. Here you have 2 green bars, red bar, short. Green bars, red bar, short. Just an example of a bearish saucer trade. Let me turn it back over to Bob to cover some of the awesome oscillator tips.
Awesome oscillator tips. These are awesome tips for the awesome oscillator. If changing the default lengths of the SMAs, it is best to utilize a short and long length combination. Example, an 8 and 55 is generally better to test within a 13 and 21 combo. Try and stay with the Fibonacci sequence as well, since it seems to be the way that Bill Williams intended it. The Twin Peaks setup is a reversal trade setup, similar to divergent setups, which try to play slowing momentum. Traders familiar with trading divergences can utilize these concepts with the Twin Peaks setup. If you would like to learn more about the basics of trading divergences, please look for the free Intro to Trading Divergences at Path Trading Partners website. That's pathtradingpartners.com. Saucer trade setups works best in moderate to strongly trending markets and during busy market hours. The Awesome Oscillator can help a trader identify both reversal and continuation setups. Reversal trades are better when the momentum is slowing and the market could be set up to reverse directions. Continuation trades are better when the market is exhibiting directional momentum and providing trades in the direction of the current trend. So buying dips in RR zones, situations like that. Thanks for watching, guys. Follow us on Twitter at path_trading and like us on Facebook. And you could always visit us at pathtradingpartners.com. There's free stuff up there. There's classes you could pay for as well, but there's plenty of free stuff for you to look at. And please listen to our podcast, The Money Path, which can be found on the website as well. Check out the blog articles, and we appreciate you guys watching. Cheers, everyone.